The yen falls and Japanese bonds are sold heavily after the election of a new prime minister who is expected to oppose rate hikes and borrow much more. Vietnam's GDP surges with front-loaded exports to the US. That's coming up in our 5 Things in 5 Minutes on Tuesday, October the 7th. And then in our deep dive interview, ANZ Economist Arindam Chakraborty explains why banks in ASEAN countries and India aren't passing on all of the recent rate cuts.
On the demand side, credit appetite is cooling as households grapple with economic uncertainty, rising debt levels, and elevated real interest rates. All this points to a credit cycle that may have already peaked.
But first, in 5 and 5 with ANZ, there was plenty of geopolitical news overnight to push markets around, with the election of a new Japanese prime minister shunting the yen down and hitting prices of Japanese government bonds, or JGBs. Here's ANZ's head of G3 Economics, Brian Martin, speaking from London this morning.
The reason the yen fell is because markets expect that her appointment will lead to a more gradualist approach to monetary tightening from the BOJ. It is also expected that the appointment could fan a more expansionary fiscal policy, increasing the supply of JGBs on the bond market, and that is helping to push bond yields higher. In fact, the 10-year yield in Japan rose to its highest level since 2008.
Also in geopolitics, the US government shutdown is dragging on and France's government resigned last night, prompting calls for fresh elections. Here's Brian again.
Overall, the political situation that we're seeing in Europe and the US are growth negatives, at least in the short run, if they extend for much longer time.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.35% and the Nasdaq up 0.75%. The 10-year US Treasury yield rose 4.8 basis points to 4.166%. Gold up again 1.7% to $3,976 an ounce. It almost got through $4,000 an ounce, hitting a new high overnight of $3,994 an ounce. West Texas oil futures rose 1.6% to $61.85 US a barrel. That was after OPEC Plus announced only a small increase in supply. The US dollar index up 0.4% this morning. The Aussie dollar up also 0.2% to 66.16 US cents. And the Kiwi up 0.1% at 58.36 US cents. Number 2, Vietnam's annual GDP growth rate accelerated to 8.2% in the September quarter, and GDP has grown a much better than expected 7.8% in the first 9 months of 2025. It's all about front-loading of exports before tariffs are applied. Here's ANZ Economist Kausani Pasak.
The growth in third quarter was mostly driven by manufacturing sector, which grew by 10%. This strong rise in activity was mostly due to factories increasing production to fulfill higher demand ahead of the imposition of tariffs. We expect activity to normalize in the coming months as export demand moderates.
Number 3, ANZ New Zealand's Commodity Price Index came out yesterday showing a 3.2% fall in the world prices for dairy products in September. ANZ New Zealand agricultural economist Matt Dilly explains.
The main driver for that is strong milk production, not just in New Zealand, but also in other key exporting countries such as the US, Argentina, Uruguay.
Yeah, why is production up in these places? Because there has been a time when production's been contained by weather and other things.
It's just really profitable right now to make milk, no matter where you are in the world. Milk prices are really high, and feed prices, other input prices are flat or dropping.
Number 4, we get inflation data out of the Philippines later today. ANZ Asia economist Arindam Chakraborty expects a jump in the annual rate to 2.1% in September from 1.5% in August.
The jump is largely driven by higher rice prices following import restrictions aimed at supporting domestic farmers. However, softer vegetable and fish prices likely helped offset some of the pressure. Transport inflation is also likely to have risen due to higher fuel costs, while utilities inflation eased thanks to lower electricity tariffs.
Number 5, Thailand reported another fall in its consumer price index yesterday with core CPI deflation of 0.65%. That's the weakest rate since August last year. Here's ANZ Asia economist Crystal Tan.
Most major non-food categories posted deeper deflation. Recreation and education remain the only major categories still recording positive growth, but even this has shown signs of moderation. Now, beyond subdued price pressures, Thailand's growth outlook remains challenging. The economy is facing a range of headwinds, including US tariffs that are dampening exports, tourism fatigue after an initial post-pandemic rebound, negative credit growth, and also weak consumer sentiment. So these factors, combined with persistent deflation, do reinforce expectations that the Bank of Thailand may consider another rate cut to 1.25% at Wednesday's meeting.
Crystal tan there. Now, in our deep dive interview, ANZ economist Arindam Chakraborty explains why banks in ASEAN countries and India aren't passing on all of the recent rate cuts. It's not just on the supply side with a lack of liquidity and higher non-performing loans, as Arindam explains.
On the demand side, credit appetite is cooling as households grapple with economic uncertainty, rising debt levels, and elevated real interest rates. All this points to a credit cycle that may have already peaked.
Yeah, so of all those countries, starting in ASEAN, where is this lack of transmission the most obvious, or the scale of it the biggest?
Right, so the transmission has been uneven in the region, and Malaysia stands out with rates adjusting in line with policy thanks to a regulatory rule requiring banks to act within 3 months. But elsewhere, it's a mixed picture. Indonesia saw lending rates rise despite a 125 basis point policy rate cut. In India, the repo rate cut led to a 17% drop in deposit rates, but a stronger 51% drop in lending rates thanks to the EBLR framework, which links loans to external benchmarks. Thailand and the Philippines saw modest pass-throughs of around 30 to 40%. Highlighting the weak overall transmission.
What's the issue with liquidity that is stopping some of the effects being passed on?
So bank liquidity has considerably tightened in the Philippines and Indonesia. That is having an impact on lending rates as there's a lack of funds with banks.
And just looking at the loan deposit ratios, where there is a lot more lending going out, if you like, than deposits coming into bank deposit accounts, what's the reason for that imbalance there?
So loan deposit ratios have climbed across most of ASEAN and India, driven by stronger credit demand outpacing deposit growth. Thailand is the exception, with a falling ratio due to weak credit demand amid high household debt. In India, the loan deposit ratio is now above pre-pandemic levels, reflecting a robust loan growth with sluggish deposit mobilization. India also has a high share of time deposits, which are slow to reprice. Hence, banks face elevated funding costs, limiting the pass-through of rate cuts to deposit rates. This in turn compresses the net interest margins and weakens the overall impact of monetary policy.
And what about non-performing loans? What's the picture there across the region and India, and how is that affecting the pass-through?
Right. So while overall non-performing loan ratios have eased across the region, rising stress in consumer loans is becoming a key drag on monetary transmission. So consumer credit has grown faster than total loans in most economies, but asset quality in this segment is deteriorating. Indonesia's consumer NPLs are at their highest since 2020, prompting tighter lending standards despite rate cuts. Thailand hit a record high in early 2025, and the Philippines remains well above pre-pandemic levels. Even in India, where overall NPLs are at a decade low, early signs of stress in unsecured retail loans are emerging. With consumer loans making up a sizable share of total credit, this pressure is dampening the overall effectiveness of rate cuts, especially through the lending channel.
Why is there such weakness in demand, and why are we seeing these non-performing loans rise? You'd think with interest rates being cut and some of these economies growing reasonably well, that consumers would be in a better shape.
Right, so basically trade cycles in the region are starting to ease after a strong post-pandemic rebound. Softer income growth, weaker investment sentiment, and moderating domestic demand are cooling credit momentum. While the Philippines still shows resilience, most other economies are seeing a slowdown. In India, early signs of household stress are emerging with slower borrowing and increased use of collateral like jewelry and financial assets. It's a shift that signals caution in the credit landscape.
Arindam Chakraborty there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, October the 7th. Catch you tomorrow with that preview of the Reserve Bank of New Zealand policy decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.